This week, we're talking about how the mortgage world looks at income for self-employed homebuyers. Start off by looking at the definition of self-employment. You are self-employed if you own 25% or more of the business. You might be involved in different companies, and so then we're going to consider you self-employed on the ones that you own more than 25% of. There are 4 types of self-employment statuses that you can have within your company. You can have a sole proprietorship, and that's just where your income is going to be shown on your personal tax return. Or you can have an S Corp, that's the second type. You can have a corporation, or you can be part of a partnership. Each one of these is looked at and calculated slightly differently within the mortgage industry. Let's start with being a sole proprietor. This is where your income is being shown on your personal tax returns. Therefore, we're not going to be asking for any business returns because they don't exist. One thing to keep in mind is that we are looking at your net income, not the gross. So this is after the deductions, and there are a few things that we can add back in. For example, your depreciation and your depletion. There are other things, but those are just the main ones that will look at your net income, and then we'll be able to add those back in. This is one of the many reasons why we need the full tax returns versus just like page 1. If you have an S Corp or a corporation, then we're going to need the 2 most recent tax returns along with your K1s. That means we're going to need your 1120Ss or your 1120s along with your 1040s. If you have a partnership, then we're going to need your personal and business tax returns. So those are the 1065s. And then we're also going to need a letter from your CPA stating your ownership. Since it's a partnership, so the K1 is just going to show equal partnership or equal ownership amongst all partners. So we need your CPA to specify your percentage. One thing to keep in mind is that if you have had your company for over 5 years, then we can base your income off of last year's tax returns. If you started the company less than 5 years ago, then we're going to need to take a 2-year average, a 24-month average of the last 2 tax returns that you filed so that we can get a sense of what your true income is. Naturally, with all of these, we want to make sure that your income is staying the same or going up versus declining. No matter which type of self-employment entity you are part of, we are going to need to show the underwriter that your income is stable or increasing. You're like, well, it came down a little bit. Okay, so what's a little bit? 20%. As long as any decline in income and what we calculate for your income, as long as that is less than 20%, then it's fine. If it's more than 20%, then that's going to pose an issue for qualifying for a mortgage. In some cases, we might need to see a profit and loss statement for the current year, along with a balance sheet and potentially some business bank statements in order to show that the income is consistent and staying at the same levels that it was on your previous tax returns. In all instances, we're going to need to show that your business is still operating at the time of closing on your loan. Since the documentation that we'll be using to calculate your qualifying income might be fairly old relatively to when you're purchasing your home, the underwriter is going to make sure that you have an active business license, active website, we can find you in directories, right? That you are still operating as a business. Now let's say you receive a K1, but you have less than a 25% ownership in it. In that case, we're going to want to see that K1 and make sure that the distributions listed on it, which is line 19, match or exceed the ordinary income that's listed on it in box 1. As long as that lines up, then we can use that income towards qualifying for a mortgage. If any of these elements that I've talked about today around being self-employed relate to your situation, then it is of utmost importance that you start your pre-approval process a little earlier than most, because you'll want to make sure that your loan officer and the loan officer's team has the time to review all of the documents, make sure they have all the necessary documents, double check with how underwriting is going to be calculating your income so that there are no surprises. And then in some cases, there might be some other program that actually fits your goals better. But you're only going to be able to know about that program if you give your underwriter and your loan officer time to review everything, look at other programs, figure out what's best, talk to you about them, and then structure your loan. There is your overview of how the mortgage industry calculates self-employed borrowers. Next week, we're going to jump into kind of some of the funkier income, right? Because you've got your W-2s, your self-employed, and everything else. Next week is the everything else. See you there. Ciao.